I want to welcome everyone to our third huddle of our huddle series. This huddle is called Demystifying Family Office for Growth Companies. And the reason why we chose this topic is because the Marion Capital team often meets founders and executives of very promising companies that are often hesitant about reaching out to family offices for one or more of the following three reasons. Number one, the executive entrepreneurs heard from someone or read somewhere that reaching out to family office is often a dead end. They're not going to get anything out of it, so they just decide to step away. Number two is they have the misconception that family offices don't do much venture investing, and if they do, then they will do it. Their company has little chance of being funded. Now the third one is they say, I don't know anyone who can introduce me to a family office expert, to an industry expert. So why would I even attempt to reach out to family offices to raise capital? So my name is Andres Guevara. I'm an analyst at Marion Capital. Marion Capital helps innovative growth companies solve their most pressing challenges through five key areas where companies need to excel to provide long-term value to their investors. FinOps, Data Ops, RevOps, HR Ops, and Special Ops, which we associate with sort of management consulting and process improvements. I want to introduce our panelists. I want each of you to introduce yourselves. We have a very strong lineup of panelists, very experienced and tenured panelists who will share their expertise. So I would like each of you to introduce yourselves, where you are based geographically, and discuss your company, investment focus or industry stage preference, if it applies. So why don't we get started with you, Lenore, then we go Connor, Steve, and then Matt.
Okay, sure. So my background is I've been in the alternative space for about 30-ish years, both sort of on the buy side and also on the sell side. But the consistency is, I've been working with family offices and institutional investors in terms of their investments, their investment preferences. So I began my career at JP Morgan on the lending side, and then I switched into the capital market side, and then I got in the alternative space, and as I mentioned, about 30 years ago. In terms of my experience and in terms of growth companies with families versus, say, institutional investors like private equity firms or venture capital firms, I've worked with both on the fund side, so on the GP side, and also on the growth company side. I'm currently at a firm called Gotham Green Partners, and we're a cannabis-focused investment firm. We focus on cannabis and health and wellness. We're pretty agnostic in terms of stage, so we invest in everything from seed stage, early stage, to growth stage. We are more particular, and the bar is definitely higher for earlier stage investments. And sort of a consistent factor in our investment process is, is there a hole within the supply chain that this company might fill? So we've backed a few companies that have fit that criteria. In terms of type of investments, we prefer structured, investments if we can get them. And in certain emerging industries, you're able to do that. So we've done credit investments as well as equity investments. So it really is kind of situation dependent in terms of how we structure our investments. Yeah, that's it.
Thanks, Lenore. Connor?
Yeah, sure. Connor Brown. I'm a founder and the CEO of City Different Investments. We're an investment management firm based here in lovely Santa Fe, New Mexico. I actually grew up on the East Coast and came to Santa Fe right out of undergrad, right out of Princeton, to work at a large institutional investment manager here called Thornburg Investment Management. I worked primarily on public equities there for almost 20 years. But me and a handful of colleagues have started City Different Investments together, we have traditional investment strategies, fixed income, public equities, but we also have built out a small business acquisition practice here. For both our traditional strategies and especially for that small business raise, we were interacting with and actively fundraising from the family office community. So we actually have a successful commitment against our first small business acquisition, largely from that community. So we're pretty, we've been in the flow of what it is that those investors are looking for, how the world perhaps has changed some in the last 6 months. I'm excited to share some of that with all of you.
Thanks, Connor. Go ahead, Steve.
I am Steve Diamond. I spent 20 years in the hedge fund space. As a hedge fund manager, I ran a couple $1 billion global emerging markets hedge fund. I ran it out of New York and Singapore. I live in DC now, where we moved after I returned client capital. I've been running our family's capital for the last 8 years. I've spent a large portion of my time on the private side, investing in the seed stage, Series A. I was the CEO of one of the companies I was chairman of for a 2-year period. So I've been on the other side of the table. Also, we're raising money for a pre-Series A company. Currently, my focus is more on the public space because the public space prices have corrected a lot more than they have in the private space, and because the opportunity set is much better than it has. But I do have a lot of perspective and obviously still have a portfolio, and I'm still making investments. The bar is pretty high.
Matt, take us off.
Hi, good afternoon, everyone. Matt Milinrich. I work at MKM LLC. I've spent north of 23 years working with a number of hedge funds, family offices, and buy-side organizations. I'm based in South Carolina and New York. My present tense job, last job was at Bluecrest, which is one of the larger family offices around. I help them look at a number of early stage businesses. So I've been in the early stage ecosystem. Present tense, I'm helping founders and direct families. So happy to have a different lens than a number of people here, and excited to be on. So thanks for having me.
Awesome. Thanks, Matt. So I want to introduce to the audience what we're going to be discussing today and the questions that we're going to aim answering with these questions, with the questions that I'm going to ask you. So number one is, what are family offices looking for in growth stage companies? We're going to be asking, what is the appetite for new deals in the current economic environment? We're also going to be asking, when is a small company too small for a family office to look at? And then lastly, we're going to discuss the most common mistakes that you have seen by entrepreneurs and how to avoid those. So I want to start with a very broad question. What are family offices looking for in growth stage companies? Connor, why don't you get us started there?
Yeah, I think I guess I would frame it more as what has changed in what feels like a pretty new and different environment. So interest rates have increased a lot this year. The cost of money is higher than it was. I've been sort of surprised at how the rippling impacts of higher interest rates have made even very large pools of family office money feel tighter. Things aren't monetizing like they had expected them to. It feels harder. I think just as Steve said, I think the bar today is much higher than it was even a year or two ago for especially proving that the money that goes into an early stage startup today can last that business much longer than what they would have been looking for a couple of years ago. 12 months of runway post a raise was enough a couple of years ago, and that might be 24 months that they need. So I think today, the sort of venture deals that family offices are looking for are higher quality, closer to commercialization, and I think family offices want a raise that they feel will get a startup business further along than maybe we've seen in the last few years.
Lenore, what are family offices looking for in growth companies?
I mean, I would agree with everything that Connor just said. But I would add, I would add to that, is, similar to what we're looking for in terms of when we look at, growth companies is, a differentiated IP, sort of a solid business model, management, ideally management who's had some experience and some success in terms of starting other businesses, exiting other businesses. Also, depending upon the family you talk to, I mean, family offices, if you look at 20 years ago, there were not a lot of family offices. The number of family offices today is probably, if you Google this, it's just in the US, it's, 19, 20,000. And these are families that have over 100 million in assets, right? So these are maybe not necessarily officially family offices, but basically they act like a family office. So you have a lot more quantity in terms of people that are in the, investing in the universe. And I would say, like what I've seen, if you just look at the cannabis and wellness and health and wellness space, is, that for emerging industries like that, I feel like family offices are definitely the first movers, and they definitely seem to have a higher risk appetite, or will tend to invest in earlier stage type of businesses. More mature businesses, I see an appetite, just the families that I've dealt with, more of an appetite for more mature companies, more proven companies. So, I think it ranges. There's a huge dispersion in terms of risk appetite amongst the families. I wholeheartedly agree with Connor in the sense that the bar has gotten high for everybody, not just family offices. I mean, we have a lot of dry powder on the side, and we're taking it slow. We're taking our time. We're structuring more deal, we're doing more structured investments as opposed to straight equity. So the environment has definitely changed, and I don't think we haven't really felt the effects of interest rates yet. I mean, we've had a huge increase in interest rates, and that hasn't really cycled through the system. So I think this is sort of in process, this readjustment.
Matt, Steve, anything to add?
Steve, I'll jump in if it's all right. This is Matthew. I would agree wholeheartedly with what Lenore and Connor had to say. The one thing I would add is, in this environment, I think a lot of families are looking to understand there's been some discrepancy between private companies they've held versus public marks that they're seeing in venture and private equity portfolios that are in either commingled fashion or, direct investments they've had that are in the public markets, that you see price realization in the public markets, but things have not been marked down in some of the private equity and or venture books. So there's some concern around price marks and price discovery. And I think I would echo, what Lenore and Connor had to say on the impact of rates not really being felt just yet. So I think people are looking for prices to settle and be realized a bit, but I do see a lot of dry powder for good quality deals. I would also echo back the bar being raised a little bit versus what we may have seen 2-3 years ago here.
The two things I would add, speaking to people who would want to approach family offices, is the first thing is that not all family offices generally reflect the personality of the family. So I don't think you can think of them as sort of as being quite as generic as, say, you could a fund companies, right? Which in even those situations, they reflect the founders, but I think that they're even more idiosyncratic. And the thing I'll tell you that I think is different also is if you can find a family that has expertise or experience in your space, and you can approach them from the point of view of, look, I'm looking for a partner rather than I'm looking for a check, I think you'll have much more success. So if you think about it this way, if there's 19,000 or 20,000 of these, I would really try and do that. If you were to think about your funnel, I wouldn't think about the full funnel. I would pick the ones that make sense, and I would find ways to reach them either directly through something like LinkedIn, just reaching out, or through contacts you have. And I would approach them from the point of view of saying why this would be of interest to them. And I think what's really happened is, the bar is being raised, as everybody's saying, in terms of what people want. They want you to have enough money. They want to know how you're going to get to cash flow break even. Businesses are no longer selling on price to sales and, LTV versus CAC, because all the guys who, because nobody really knows what the LTV is. So when you're spending over, $150 to get a customer is going to make you $60, you better have a good reason why that's going to be better than $60. So what I would say is I echo all of that. And I would really treat families as, really go through your funnel, find the ones that really make sense to you, and approach them to be your partner, not your piggy bank. And I think you'll have much more success that way, because echoing what the other panelists said, it's not like these people have lost all their money. They're just being careful, and they need a higher level of confidence. And that will come both from what people have spoken about, which is a combination of where the business is in its development, the paper that they're getting to protect themselves, and then adding this sort of third layer of expertise, meaning they can understand it. It's in their wheelhouse.
Thanks for the insightful comments. So to provide a little bit of background, in a survey conducted in 2020, the average family office's venture allocation constituted 10% of the family office's assets under management. The family offices indicated interest in increasing their venture allocation in future years. As of January of 2022, the same family offices were surveyed, and they reported slightly higher venture allocation of 12% versus 10% 2 years ago. So, Matt, what is making these venture deals increasingly attractive for family offices in general?
I think you've had a couple dynamics in the recent years, and I think just to take the raw numbers, 20% increase is a real number. So I think that's a really good stat. And I think, to peel it back a little bit, you've had some price discovery in the public markets that was different than what you could get in terms of compensation for being longer duration money. So what I mean by that is you've seen a lot of families move into private credit. You've seen a lot of families move into private equity generally, into venture generally. I would bet that if you looked at that stat across everything longer duration, people have extended even a larger component of their book into those three buckets. And I think that trend is probably got some legs left, but we're going to have to wait and see where we get to in sort of the higher rate environment here. But I think people have been compensated for longer duration, getting involved earlier in businesses. So that explains a lot of the trend in terms of the families that I deal with. So that's how I see that, Andres.
Anything to add? Steve, Connor? Awesome. So I
guess the one thing I'd say is I wonder if you did that survey today, if they'd still express an interest in more in venture capital. And maybe that's a temporary thing, but the result might not be the same today.
So how do you expect this appetite for venture deals to look like during 2023? Matt, Matt indicated some levers that we have to see there, but
Are just a question for you? Are you talking just within the family office universe? I mean, because the broader universe is also the venture firms who have a lot of dry powder. Yeah.
Right. I'm talking only within the family office universe. Any thoughts there?
That, I mean, it's hard to predict. And from my lens, you know, I hate to keep repeating the same thing, but look, I mean, family offices, and Steve made a great point to say in terms of advising growth companies, is to focus on people who are strategic, who know your domain, and approach it more like a partner. I think that's great advice. So, you know, I think I would, I would strongly recommend that. I think, you know, 2023, I think will be an interesting year in that 2022 was a very challenging year for a lot of people. Private equity firms are now just marking their books down. And, you know, again, sort of the economy, sort of, we have to see sort of how rates play out in the economy. I think that there will still be a decent appetite for the right venture deals going forward. I think that, you know, I know we're only supposed to stick to family offices, but I'm just putting my hat on in terms of advising growth companies is, you know, there are a lot of venture firms that have, you know, this domain expertise with a lot of dry powder. They have to put the money to work. Families don't have to put the money to work, right? If they're getting scared and if their, you know, risk appetite has gone a little bit, you know, has gone down, you know, they don't have to make investments. So I would look at it holistically. If I was, you know, to advise somebody, is to focus on both families and venture firms that focus on sort of your, you know, what you're focused on, what sector your company's in, and yes, approach it more like a partnership. I think that for the right companies, the money will be there. Certain sectors are going to fare, I think, better than others. Health tech has definitely been one sector that is garnering a lot of capital from families. And then you probably other sectors like perhaps technology or Web3 sectors, it's probably going to be more challenging. So I think that also is a factor.
Yeah, yeah, I think that's great. And I think those are some great points. One thing I would add that is just that everybody knows that the best vintages of investments happen in the worst years, right? So everybody knows they get the best returns in a tough point in a cycle. And if you were to look at this period, everybody's looking at it as a tough point in the cycle. So I think, you know, the point that Lenore makes is a great one, which is there's going to be money there. It's just going to be harder to get. And it's probably going to be a little more expensive, but people will invest. And I think I'm going to say it again, echoing Lenore, echoing me, is really focus on people who understand what you do. Like, people are not going to dabble the way they would previously, right? You're not going to have, you know, doctors and dentists wanting to put money in some name from someone at a country club the way they would in a booming market. But the professionals, it's their business to put money out across a cycle. And families, you know, those 19,000 to 20,000 families have a scale of assets that they will be making those commitments. And, you know, there's only going to be one end of the world. And I don't think people are going to be behaving like, you know, even when that one comes, we're all better off not behaving like it is the end of the world. Because, you know, we all get scared of a lot of them that don't come.
Connor, anything to add from your perspective?
No, Steve made a great point, which is when you've met one family office, you know one family office. You don't know them all. They are so different and so unique. But I don't think I can emphasize enough that I think the world has changed. And if you're out there looking to raise capital, you need to know and understand that. And the contraction that happens throughout the system to make capital much harder to find I think it's real, and I think we're really only on the front end of that in terms of seeing the impact and funding capability. So that sucks if you're out there having just started a business trying to find the money to run it. But I think if you know that, if you plan for it correctly, you can prepare yourself for what that newer, tougher fundraising environment looks like. Not be surprised when you go out and face it.
Yeah, and I'm sorry, just to add one more
Go
thing.
ahead.
What we're doing and what we're seeing in the market is, this is for founders, is structure. I think I mentioned this, is we're seeing a lot more debt, venture debt actually, in that it's less dilutive. You're not sort of raising capital at ridiculous levels. Obviously, you have to have the cash flow for that, but we're seeing that as well.
Yeah, that's a great point. Yeah, I was going to ask, how do you prepare for that? How does an executive entrepreneur prepare for to go out to fundraising in this environment?
Yeah, so let me throw something out here, and others will have better ideas of how to do that. But something I've heard from family offices is we're looking for more singles and doubles rather than grand slam home runs in this environment. And once again, Steve, I keep referring back to you. Like, Steve is probably right. It's actually a great time to look for the grand slam because nobody else is looking for it right now. But that's just not how the world works, with people getting scared in a scary environment. But that's a great idea, venture debt, which secures the investment and protects some downside risk for an investor entering in. And then, preparing for how you want to scale your business, how quickly you want to spend money to get to size. I think if you present an option to investors that doesn't scale quite as quickly as you might like to in a different world, but gives you much more runway for every dollar invested into the business, is something that might look more appealing in an environment where people are scared of riskier investments.
Awesome. Well, thanks for sharing that. So I want to jump to say another topic here. So, or within the same line of thought. I want to see what's your first reaction to this chart? Is it what you expected, or is there something that surprises you from these numbers here?
What's the percentage of? Is that the capital commitment, the number of deals?
That's the number of deals.
Yeah, so it'll be distorted because on a dollar value, there's obviously
Right.
Series C plus, those dollars would be very different than seed.
Correct. Yeah. So this is focused on number of deals.
Yeah, so I don't,
yeah.
yeah. So my point to this was that it doesn't tell me that much because it's really about where the dollars are going.
Mhm.
That would tell me more. It just says that, if you look at it, everybody's sort of doing everything and, it's more even, but I think that you'd have to give me the dollars for me to try to interpret it.
Yeah.
That's fair. Matt, so there's obviously, the point that Steve brought up, but we see more family offices focusing or doing more deals in Series A rounds. Why? To what key factors do you attribute these behaviors, these decisions?
I'm just going to be transparent. I don't have a strong reason for why families would be geared more towards Series A, because I want to go back to the point that Steve, Lenore, and Connor have all made, and hopefully we've gotten this across. You meet one family, they're very unique and different from, I've worked for 4 very different families in my career to date. I don't think it's easy to broad stroke family office as a category. I think it's more challenging than probably any other investor you're going to come across because they're all unique and different, have different approaches. Some are obviously well situated. I'd view them as professional investors. Others are more transient and more first gen. So my answer is I don't have a good answer for why Series A would be more prevalent. I truly don't. So some others might. I think this mix of a variety of deals is what I would expect to see, but I go back to Steve's point. You have to sort of look at dollars invested versus, number of deals. But I don't have a great answer for why Series A versus others.
But yeah, look, and the other part of that is just why I was sitting here trying to answer that. The one way one could answer that is you've got to look at, there's probably the most number of deals that a family office would see would be Series A, because seed deals would likely be friends and family. And then, the percent of companies that make it out of Series A is probably, I don't know, that's a number somebody would have, but my bet is that number is, less than 50% of the people who do a Series A ever get to do a Series B, because Series A effectively is the point in your career where you're making the claim that you have product market fit and that you're raising money to scale and grow. And that's where, that's the easiest place to crash and burn, because you're like, oops, we didn't actually have something that we could scale and grow. And so Series B is just a far fewer number of companies than A's.
But by the way, speaking of, I'll bet this is dollar value of deals rather than number of
No
deals.
way, couldn't be, because the dollar value put into, that would be shocking if it was.
I think it'd be skewed different, honestly, if this were dollars, just from my view.
But on the other hand, do you really think there are as many Series C plus deals as seed deals out there in the world?
No, I don't think there's a number of deals, but I think that the families are buying those deals, right? Because those are deals that will be shot by a bank or a broker or somebody, and so that's where
Family
there'll be
office activity in those deals.
And I think you need to look at the sample set as well. I don't know how many families there are here, but there are 19, 20,000 families. I don't know how many families.
This is about 140 families here.
Yeah. Cool.
Well, that's very insightful. It's a very insightful discussion. So thanks for that. Lenore, so how important for your fund, how important is deal size and stage to a fund that has such an exclusive focus as cannabis?
It's completely unimportant. So we've done seed as small as 2 million, $1 million. I think we don't really do any of that anymore, but and then we've gone up to 250. We'll do co-investments. So we've got 7, 8 co-investments, SPVs that we run as well. So it's cannabis is a different area, and it actually, if you look at your pie chart here, it actually makes sense within a very within cannabis, which is a very it's actually growing industry, but it's right now it's an emerging industry. And the reason, so there's any cannabis operators out there. The reason I believe that these numbers would actually jive within the cannabis space is it's an emerging industry, and an emerging industry, by definition, there are not a lot of late stage deals around, right? So you have most of the volume that comes across our desk is going to be seed to state, Series A or Series B. I mean, we have a few D, E, and F, but there's not a lot, right? It's really skewed. And if you look at the cap tables of these companies, which we do, they are largely ultra high net worth and largely family offices. So it within the narrow sector of cannabis, you definitely find an appetite from families and ultra high net worth for earlier stage deals. Yeah. Did I answer?
So yeah, definitely. So how has your outlook changed since the recent midterm election on this industry?
Oh, cannabis. You know what? It really hasn't changed that much, because cannabis now has become less of a less of a partisan issue. It's really more bipartisan. It's really more of a demographic issue. It's an age issue. It's, boomers or, older people versus the Gen Z and the zillennials and the millennials. And so if, many polls, about 2/3 of this country want it legalized, states continue to legalize. Kevin McCarthy, our new House Speaker, has voted for the Safe Banking Act. So what's probably going to happen within cannabis is going to be a narrow, not, Schumer had a bill that was the kitchen sink. It had too much social equity. It had too much in it. The Republicans would never go along with it. But the Safe Banking Act is basically allows cannabis companies to be banked and to have, debit cards, credit cards, and it basically allows them to uplist on the NASDAQ, the New York Stock Exchange. So we think that's a pretty high probability of happening, and that is a bipartisan bill. So it will be, people are saying it's going to happen by the end of this year. I don't know if that's the case, but it has a pretty good shot of passing.
Well, thanks so much. Before jumping on to the next topic, I want to remind our audience to send your questions in the Q&A box if you have any questions to ask to our experts today. But I want to shift our gears to the most common mistakes that entrepreneurs make, when reaching out to family offices. So often, entrepreneurs and executives at growth companies conduct cold outreach to family offices, as part of their fundraising strategy, and then that often yields unsuccessful results. So this is a question for whoever wants to answer it. But through which broad categories do you find yourself sourcing new deals, and how has that changed over the past few years?
So one thing I would say here is I'd sort of make two very specific points. The first point I'd make, again, is, we keep all saying this to you, but number one, not everybody is the same. So be targeted, right? Know who you're going after and make sure that you have a message that is appropriate for them. So if you bring me a med tech company, I just don't know anything about the space, I'm never going to invest in it, right? So I'd be very, very targeted there in terms of your outreach to them. And I think the other thing that this clearly says is it's obviously better to get introductions to people who will vouch for you, because I think particularly when you're dealing with anyone, but families even more so, it's like the founder and the person is the first thing that, certainly in my case, that I would look at, right? It doesn't matter how good the idea is. If you can't trust the person, it's very hard to give them money or to even, take a pitch particularly seriously. So I would definitely make sure I target the right people, and I would seek introductions as much as possible. And if you are reaching out cold, to really make sure that it's like, hi, I know you made your fortune in the candy business. I have a great idea for candy, right? And then that's a fit, and there's something to talk about.
Yeah. I just add to that is, traditionally it's, they're investment bankers, and we actually get our ideas from, a real combination in terms of sourcing. So it's proprietary. It's our investors. We have a lot of families as investors. They get they get flow, and they, give us a call and ask us what we think of something. And that's a way to source deals. And believe it or not, this happened actually quite recently, last week, is LinkedIn. People, reach out, and I had a very interesting conversation with a company last week who reached out to me via LinkedIn. It helped that we had common people that we knew. So that really helped. So if you're going to reach out via LinkedIn, see if you can find some common people that know this person.
I guess I'd add, we're doing the same thing to try to sell and market our investment strategies. And cold emails are terrible, whether to RAAs, family offices, anything. I think so many people are getting emails that they just get totally ignored. Phone calls, interestingly, higher hit rate for us. Go back to the old way. LinkedIn has been successful for us, but in targeted ways. I find rather than an in-mail on LinkedIn, if someone agrees to connect with you, to then follow up with a message is a higher, we found a higher success rate through that. And then in every meeting you go to, asking, who else do you know that might be interested? Who else can you introduce us to? And while a cold email works not at all, what's so fascinating is if I have just met someone because someone else introduced me, and I'm now talking to someone for the first time, but they introduced me to someone they know, even though I've only just met them, you get the response from that person that they know, which is just wild. So, you know, I think we're all getting bombarded with so many messages, so many people trying to sell us things, so many politicians trying to raise money. And anything that we can do to sort of filter out and figure out what's important out of that helps. And the biggest thing for us is email introductions to other people that people know gets us in the door most often.
Yeah, I'd like to follow on to what Connor just said, because I think that's really important. And I'll just extend that a bit further. In my dealings with investing on behalf of family offices and for us, what I find is, to his point, people are receptive to tell you upon first meeting and or upon first investment, their closest friends and people they invest alongside, because unlike any other cohort, family offices like their friends involved more often than not, right? So they're glad to introduce their network that might be strategic, that they've gone into health tech deals, you know, whatever variety of deal you're in the market with. I think the idea of piling on in a positive way and saying, hey, you know, we view you as strategic investor X and family office Y. Who else do you think we should be talking to? That's actually a really powerful statement. So I wanted to reinforce that, because I think that's a really important point he just raised.
It's so easy to forget to do it on a call or a meeting too.
Steve, anything to add here?
No, I think it's a very, Connor brought up like what I would say is a golden rule, and it's often overlooked, which is, you know, when you meet someone before you leave, there's nothing wrong with saying, hey, do you know anybody else who would be interested? And it is true that an introduction, even if you've only met the person for an hour, is an introduction and will be looked upon very differently than a cold email to that same person.
So Steve, going further into the, you know, the outreach, what are family offices looking for in executives? Like when you have that first meeting with a founder, with an executive, what are you looking for in that first meeting?
Well, and this again will be very different. Again, I don't think everybody's going to have the same answer, because everybody's a different person. Look, I think there's a very simple framework you can sort of put together, right? I think the first thing everybody looks for is, do you like the person? Because if you don't like someone, it's really hard to be in business with them, right? And then I think the second thing that people look for is, you know, is there any way to know you can trust them, right? And if you know you like them and you know you trust them, then the next thing you're really trying to figure out is, you know, is there a problem that they're solving that you get that there could be a business, you know, a business to support, right? And I think that's the case with everybody, right? And so I'm trying to be as generic as possible. And then the last thing you're looking for is why this person and their team are going to win. But if you don't like them, in my case, and in many people I know, I'd be interested to hear how the other panelists think about it. You're just not going to be, it's just not the right fit. And if you don't trust them, then particularly in a world where we've seen a lot of, you know, I think we've seen it very lately where there's been a lot of high profile, untrustworthy things in the last few years that have ended very badly for investors. So I think it's always trust is there. I'm surprised by the number of people who show up and want money for things because they want to do it, but they're not thinking from the customer's point of view. It's sort of narcissistic and selfish. So what is the problem that you're really solving? And in a sense, I always ask, so whose business are you stealing? And then that last piece, you start to dig, which is, you know, about the business and the strategy. And that's where you start to think about things like the TAM and the business model and all the things that you look at. But I would say the majority of I think young founders underappreciate the importance of being liked and trusted. Because at the end of the day, if you look at a lot of the businesses that everybody invests in, they go through tough times, right? The number of companies that, go directly from, startup to home run is very small. And so you need people who you're going to want to be on a long journey with, and you need people who you can trust who are going to make decisions that make sense for you when there are tough decisions to make. And I think, in a sense, I think that gets very, very underappreciated by founders.
I've got a question to ask, because I agree wholeheartedly that trust is so important. But I hear a lot of people that say that they want, the founder they're investing in of a startup to be an asshole. and that's the only way that they're going to build the successful business and do it despite of everyone that doubts them and all of the pressure that they're up against, guy or girl, whatever it is. Like, I hear that a lot. I hear that a lot from funders too.
Connor, let me jump in with a term that a bunch of the families I deal with like to say. They can be an asshole, but I want them to be my asshole, right? Like, so you want somebody that's a killer business-wise, but I go back to what Steve said. They have to be trustworthy, and your early stage businesses, you're going to go through different cycles. I think the first point that he makes is really important, but somebody being an asshole is fine, but they have to be somewhat of a personable asshole, for lack of a better term.
And by the way, let me qualify, since this is feedback to what I'm saying, to qualify is like, you've got to like them for the role you want them to be in, right? They're not going to be I don't think there's a famous saying with the consulting firms when they hire people, it's like, would you want to sit next to someone on an airplane? Because these people are going to go sit next to each other for years on airplanes in a sense, but they work together in that way. When I say like them, it's like, like them the way you would like if you were, I'm trying to think of an analogy. Like if you were going to hire a UFC fighter, right? You'd have to like the person as a UFC fighter, not as something else. So I guess what I'm saying, we're not talking about looking for like, oh, you've got to be, so you're not looking for somebody to be your buddy. You like them for the role you're putting them in, and you can work with them.
I agree. I find it fascinating though, because you want someone who will sacrifice everything to make their business and your investment successful. But it's always tricky for me. Where's that line between sacrificing everything for the business and not being able to trust them because they'll sacrifice everything to make the business successful?
Yeah.
I think just to jump in and to add to this, I think there's a high correlation between asshole and trustworthiness. Inversely,
exactly. Yeah.
So, look, there's Elon Musk, like, you got to commit to work your A plus, or else, there's that, but he's not an asshole. He's just, he's very, determined. And so, but I would add to what, Stephen, Matt, and Connor said, I would add domain expertise, and ideally a track record of history in terms of starting.
Yeah. I would say 100%, right? Part of liking someone, I guess I didn't speak very well. It's, obviously there's a saying, which is you may want to invest in someone's first startup, or you definitely want to invest in their second. So if you're in it, I think that's sort of table stakes, which is you've got to have some reason why you're the person for this domain. Like, you've acquired a certain amount of knowledge. I think it's very difficult to enter something and get funded by anyone other than friends and family if you don't have some sort of track record in the space.
I'd just like to say how proud I am that I got us all to swear on this webcast.
Easy day
awesome. Here. So I want to be mindful of thanks for the perspective. It's very helpful. I want to be mindful of our attendees' time and your time as well. So I want to jump into two questions, really three questions that came through the chat box, through the Q&A box. So the first one is for Steve. So you say you've got to like the founder in order to trust and do business with them. So first question is, what are the top three things Steve, that you look to like a founder?
So what I would say, it really depends on it's like this. I want the right person for the mission. That's the simplest thing to say. So let's just, if we use another analogy, if we've got someone who's supposed to climb, a mountain, right? I definitely am going to want someone who's fit. So I think the first thing is they've got to be the right person for that mission. The second thing they have to be is there is a level of, I don't want to say likability, like sit on an airplane, but a founder has to lead a team, right? Nobody can build a business themselves. No one can do anything. So I'll look to see what is their style of leadership, and is it appropriate for what they're about to undertake? And the third thing I look for, and this is just a personal thing, and I don't think this would be, if somebody didn't have it, let's be clear, it wouldn't take them out of the running. But I definitely don't want somebody who takes themselves too seriously, because in my experience, those people have to go through a period where they get their butts kicked and develop humility, because this stuff is really hard and they're going on a mission where 90% of the people are going to fail. And so if I can have that already in the bag, which is a sense of realism of, the way it's looked at is, I think, to paraphrase, is people are incredibly cynical and at the same time incredibly optimistic. That's something that I would look for, and not just the maturity of knowing that it's tough, but they have the conviction they're going to succeed.
How about for the rest of the panelists? What are the top 3 things that you look?
Andreas, I'll jump in. I had a boss that was worth north of 20 billion bucks. He said something to me when I was about 28 years old that I thought was laughable, but now I go back to it and I like it. And it happens to be 3 things. He used to call it the 3 T's. It's trust, track record, and timeline. So you have to be able to trust the person up front as first. Second is track record of success, as we've all talked about. And then third is timeline and execution and how you're going to make money together. So those 3 things, I think, are the 3 T's for me.
Yeah, and I would just like to emphasize the trust components. We've backed out of deals that where they were great assets, and financially it was a great deal for us, but we didn't trust the management team. So it's really important, because at the end of the day, you have to plan for when things don't go well, and if you can't trust your team, your management team, then what do you have?
So what tends to be a turnoff then? What, let's say, the key thing that proves to be a turnoff when, let's say they got the 3 T's, but then they say something, and then
changing terms, getting a term sheet, agreeing to a term sheet, and then coming back and trying to get a better deal because they've shopped it or something like that would be an example.
Matt, how about you?
Yeah, I think Lenore raises a good point. That does occur, unfortunately, whereby people try and rewrite terms as they go and find success, maybe seeing things that are price discovery wise. The other thing I would say is lack of solid numbers. You start pushing around the numbers in business models that are presented, they start not to add up. That's an immediate kick it away. And then, I do think you want somebody that's got a track record of, to some degree, proven success. So a turnoff would be first time entrant that's more of a, banker type that's coming in just because they see a deal. It's not to say it can't work, but, propensity of deals like that fall flat are pretty high. So you want a sort of domain expert, if you will.
I think too, telling me something that you don't know to be true and acting like you know it to be true, it gets me every time.
That comes with the humility that Steve was mentioning earlier, right? They're gonna have to go through a tough time, and if they want to show off, they know more than they actually do. That's when that's the challenge. Steve, what is a turnoff for you? What's the biggest turnoff? You're muted.
Look, I think
There
the
you go.
biggest turnoff is, is what Lenore said, which is, somebody who changes the term on a deal, because it's hard to commit to people. And if they turn around and, they either shop the deal or they try to take advantage of the fact that you've done all this work and you're now committed, then, that's the thing that I find the most unpalatable as well.
All right, we have another question. So you've talked about the unique nature of each family office, right? So for those, entrepreneurs that are looking to pitch network with family offices, what is the best way to identify those family offices to work with that have a specific interest in the space in which the entrepreneur's company is in? Is there an online database? How do you find them?
It's really hard because it's easy to do on the venture side. There's so many different databases. What we do, because we have a very specific silo, is I have somebody who does this full time. We call it lead gen, and we're constantly doing research, and we use LinkedIn a lot. We use Sales Navigator. You can do a lot with that. You can also Google your domain expert, or your whatever relevant keywords are to your business, and you can Google it. It's just, I know it's a stupid simple way, but we've gotten some really interesting and really high quality families involved by those two methods. I'm sure there are other ways of doing it, but LinkedIn Sales Navigator can actually be very helpful with targeting folks.
I'll jump in with something that Connor mentioned that I tried to reemphasize just for the group. I think the first order effect, there's a variety of ways to go about it. To Lenore's point, LinkedIn, you can go through a variety of queries up front. But I think as important is, once you've identified somebody that you've got a good rapport with, sort of the second order mushrooming effect of asking for their friends and cohort of people that invest alongside or like them is as important, in addition to the way you follow up and conduct that. I'm always most impressed with people that call upon me with deals that feel like I've known them for years, and somehow it's first meeting whereby they're saying, hey, X referred me over to you, or X mentioned your name. Those things make people comfortable. And 2 of those phone calls are more valuable than 100 cold reach outs in LinkedIn, in my mind, anyway.
Agree.
All right, if there's nothing else to add, then I want to be mindful of everyone's time. So any concluding thoughts from you, from the panelists? What's the one key takeaway that every entrepreneur that's listening to the call should take with them?
Be a trustworthy asshole.
Yeah. Mine is, I think,
Go ahead, Steve.
I was going to say mine is we'll call it Connor's rule, which is when you do get in the door, ask people for more names, right? Don't leave without people referring you. That'll lead you. The return on that will be incredibly high.
Yeah, and we find that to try. I would echo what both of you just said. We call it triangulation, and that's our highest hit, ratio. But I would also say how many founders have come to us completely unprepared with sloppy decks or so put your best foot forward when you approach families. Is be prepared, and both what you say and also what you write. So first impressions count.
Yeah, I'm going to conclude with an echo of both of those, just to reinforce. I think the second order effect that Steve and Connor just hit on, you have to, the highest ROI on your time is once you've identified somebody that's interested in your business, that's a good qualified investor, you have a good rapport with, extend that, make the ask. People are not offended by that. If anything, they're complimented by that. And to Lenore's point, the percentage, to put a number on it, is greater than 50% of people that come into my office where it feels like they're demoing a mock pitch to me and it's not tight. That's a waste of everybody's time. It's unprofessional. Just tighten up your messaging and tighten up sort of why you're going to win in your business before coming in to see folks like us.
That's a great point, actually. And I think it's never as good the first time it is as it is the 5th or the 10th time. So finding those right friendly parties,
Yeah.
we're going to ask some tough
Yeah.
questions, so it feels like a real pitch to practice with. That's a great point.
I think, look, I think what Lenore and Matt just said, I think are table stakes. Like, if your pitch isn't tight and you're not prepared, you only get one chance to make a first impression. You're just doing yourself an incredible disservice, because the other side of it is, people do know each other, and if that, that can corrupt your whole process. And it just, if you don't take the time to get something perfect in a pitch, that says a lot about you as a CEO. Like, if you're not going to go the extra yard, the extra mile, the extra 50 miles to get your company right. So I think, you only get that one first impression. That was a really good point you all made, I think.
Yeah. And I will say though, too, like, for me, selling is learning as you go too, because every time you get a question that derails you, you've got to cycle that back into the way that you present the information. How can I present the information that derails that before it even comes up? So you got to be really good when you go, but also be iterative and learn as you go.
Yeah. Amen to that. Agreed.
Yeah. Yeah.
Well, I want to thank all of you for sharing your insights. I mean, it's been a very insightful conversation, very candid. I love that. And so I really appreciate your time. I appreciate our attendees' time. Thank you so much for asking questions, for being engaged. And I just want to thank you all. If you have any questions, feel free to email me. Feel free to visit our website, mainstreetcapital.com. And if you have any questions, we're here. But to Lenore, Connor, Matt, and Steve, thank you so much for your time today. It was highly insightful.
It was fun. Thanks.
Thanks for having us.
Thanks for having us.
Thanks for having
Of
us,
course.
guys.
Of course. Have a good day. Bye.